Have you ever wondered, how are Bursa Malaysia's marketplace being monitored? Would you like to know how the marketplace is maintained orderly and fair? Welcome to Bursa Malaysia. We are the frontline regulator of the equity and derivatives markets. So, what does this mean for you? Through Bursa Malaysia regulation, we ensure the markets you invest in are orderly and fair, so that you have timely, accurate, and complete information to make informed investment decisions, are able to trade in a fair and efficient environment, have confidence in your brokers to provide secure and trusted services to you. So, how do we protect the marketplace? We have multidisciplinary teams in Bursa Malaysia regulation that focus on specific areas while collaborating with each other to provide a comprehensive network of safeguards for investor protection. We also work closely with other regulators and law enforcement agencies. Real-time surveillance of the market. We have a market surveillance team that acts as your market police. They monitor the stock market against irregular trading activities in day-to-day trading. This team uses an automated surveillance system to monitor trading in the equity and derivatives markets in real time. Should irregular trading activities be detected, this team of specialized analysts will fact-check and engage the brokers involved for their immediate action. Supervision of intermediaries. As safeguarding the integrity of the marketplace is paramount to us, our intermediary supervision team secures the protection of your trading and deposits through consistent broker monitoring and inspection. Disclosure. Continuing listing obligations and gatekeeping of listed companies or products. To be ASEAN's leading, sustainable, and globally connected marketplace, Bursa Malaysia places high emphasis on the quality of our listed companies. This begins from the approving of new listings on the exchange, through to ensuring that listed companies remain of quality through governance and compliance, as it is imperative for investors to be well informed in the fast-paced financial world. Bursa Malaysia regulations listing and corporate surveillance teams monitor companies' corporate announcements so that they are disseminated to you in a timely and accurate manner. Enforcement action is taken should there be any failure to do so, or should there be any material inaccuracies to the announcements made. As we are also a venue for listed companies' secondary fundraising, our relevant departments work together to ensure investors' funds are always used as mandated. We have a dedicated team of finance experts to examine corporate disclosures, including financial reports, so that they are accurate and timely that you can rely on. Within Bursa Malaysia regulation, we have subject matter experts that look at the various international sustainability reporting frameworks that are constantly evolving to ensure that our disclosure requirements are appropriately benchmarked. This ultimately drives the desired improvements in our PLC sustainability disclosures as well as practices. Taking enforcement action. So what happens when the persons are regulated by us? Be they brokers, advisors, listed companies, directors, or their representatives, breach our rules. Appropriate action will be taken against them. The types of action taken would depend on the severity of the breach. Suspected breaches will be investigated, and enforcement actions will be taken if the breach is proven. Our enforcement proceedings and actions are consistent and fair as cases are discussed in a robust manner through our regulatory committees, comprising independent individuals with relevant experience and backgrounds. Policy and rulemaking. Bursa regulation is the guardian to the 10 rule books of the securities and derivatives markets. Rules drawn up by the regulatory policy and advisory team are always outcome-focused. Industry or public consultations with the relevant key stakeholders will be undertaken, alongside rigorous benchmarking processes to ensure the rules are relevant, effective, fit for purpose, and on par with international standards. Each multidisciplinary team in Bursa Malaysia regulation is intertwined and interact proactively to ensure high standards in market integrity.
Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is The IPO Essentials, your comprehensive guide to studying initial public offerings. So my name is Shen Chu. I'm the moderator for this webinar. So today we're going to go in depth about how do we go to pick the right IPO investment. So before we begin, as usual, disclaimer: whatever we share in this webinar is only for educational purpose. In no way do we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you're solely responsible for all investment risk. All right, allow me to briefly introduce our speaker today. He first indulged himself in the SME financing industry right after finishing his diploma in finance and investment in TAR University College. So he continues to pursue his interest in the finance and capital market by joining Rakuten Trade and TS Securities, which he held the position of risk and compliance officer and dealers representative. To date, he has over 8 years of experience in capital market as an investor himself, where he also runs One to Invest, a financial blog which amassed over 60,000 followers to date. He was also an associate director at a private equity firm and is now a senior partner for a corporate advisory firm. So currently, he's also a SGX Academy speaker. So he's none other than Mr. Max Tan. So Max, how are you today?
Hello, Shane, and hi, everyone. Good evening. I'm doing good. Hope you guys are doing fine as well.
Fantastic. So I'll stop sharing my screen and hand over control to you.
Sure. Okay, let me share my screen. Okay. All right. Okay. Hi, good evening, guys. And welcome back to another session on where we will discuss particularly on the IPO topic, which is the initial public offering. And today, for those that are uninitiated, we are going to cover what exactly is an IPO and why would a company, if some people might have the thinking of why, if your company is so good, why are you going for an IPO, right? And we're probably going to talk a bit about the IPO cases back in 2025 and 2024. And we also going to go through what are the things that you need to see in an IPO. If the time allows, we are going to study one of the interesting case study, which is one of the company that has already been listed. And recently, I believe their share price has been performing quite decently. But even though I've mentioned that some of the IPO might seem lucrative, I would also like to share that there are always risks associated with all these kind of investments, especially with IPO, right? And just to understand a bit more about everyone here, about the audience here, right? Anyone has invested in an IPO before? Have you ever tried going, if you are 80s or the 90s, right? You probably went to the ATM and then let's say maybe an ATM or power bank ATMs, then you start clicking and you started to try to subscribe for the IPO. Okay. Nara said yes. Seng Hok said yes. Jason also said yes. Thank you. Thank you for the reply. So traditionally, how people subscribe for IPO, right? They would fill in a form, is what we call white form, right? And then they will hand it to the brokers to subscribe. Then there comes a time where people can start using ATM to subscribe. Then move into the times where people can subscribe IPO through online banking, right? And now you have the privilege to actually not trying to promote any brokers here, but some of the brokers, they allow you to subscribe directly through their platform. So subscribing IPO has been getting easier and easier, but it doesn't mean that us understanding an IPO is getting easier and easier. It doesn't mean that, right? So ultimately, hopefully throughout the session today or after the session, you are able to assess an IPO by yourself on a very neutral basis and unbiased basis. Okay, right, this is just the disclaimer. Again, by no means I'm a licensed person to give you any form of investment advice. So if you would need or you really are looking for this kind of advisory services, I would strongly recommend you to look for a licensed person, your broker perhaps, or investment analyst, or even your remiser, right? Okay, so we probably gonna touch one or two companies today, which is very important to note that again, those are not buy, sell, or hold recommendation. It's just for the sake of case study for today. Okay, this is about me. Shane has already introduced me. Thank you, Shane, once again. And I think we can jump straight into the topic today, right? This is for the investors or friends here who are relatively new to the market. I'm gonna kind of describe how an IPO actually works. And some of you already have the knowledge, bear with me for a while. I'm gonna explain what exactly is an IPO. Okay, so imagine this is a company, right? So IPO, as the name suggests, it means that a company is going to go public. They're going from a private company to a public company, and it offers shares to the public. Now, when I mention it in this way, it might be slightly hard to imagine. So, for example, right, me myself, I run a nasi lemak company. Let's call it Max Nasi Lemak Sdn Bhd, right? The company is a company that sells nasi lemak, and this company is owned by one single shareholder, which is me. So this is a private company with a single shareholder, right? Imagine that I'm trying to expand my business here. As the business grow, right? Every morning, 6 a.m., 6:30, 7 a.m., everyone is coming to my store. More and more people, they get to know that my nasi lemak is good, right? But I feel that if I sell low ticket size item, for example, like 1 ringgit 50 cent per packet of nasi lemak, the growth is too slow for me. Now, I'm trying to grow from selling plain old nasi lemak. I'm trying to do something even higher ticket size. For example, I'm trying to do lobster nasi lemak. Now, some of you might smile or laugh, but actually, there are people in the market that do lobster nasi lemak. So I'm not plucking this from the sky. But imagine that a store, nasi lemak store, right? They need money because I need to do something special to expedite my growth. So I'm doing lobster nasi lemak, for example. Then I also start offering new drinks. For example, like coffee, Milo, whatsoever. This is what we call working capital, which means I need the money to buy inventory or I need to hire more staff. So this is working capital. It's a capital allocated for working, right? This is one of the things, common things that you see that company raise fund for. And furthermore, let's say I'm trying to streamline my nasi lemak company even further. I wanted to set up a central kitchen. I want this central kitchen, right, to have ready to eat nasi lemak to speed up the process. For example, everyone come over here. My standard process time, I want to complete his order within 60 seconds. I don't care what his order is. I just want the nasi lemak has been ready, 60 seconds, and off you go, right? So the cost of setting up this kind of infrastructure, so I need to buy a land, I need to build a factory, then I need to start buying in machineries. So this is what we call capital expenditure. This is also one of the common reason of fundraising or companies going for IPO. This is why they are seeking money. They want to expand their business. It's either they are going through raising for working capital, which could be buying inventory, or maybe hire more people, or they are looking to invest into assets. For example, land bank, properties, a factory, machinery, etc. This is called capital expenditure. Okay. So in that sense, this might sound a bit complicated for those who are new, but as we go into the actual case study now, I will show you the utilization of the IPO proceeds of that company. I'll break down to you which is this allocated. Is this a working capital? If it's a working capital, how should us as an investor take it? Is this a good use of money? I mean, good use of money or not, of course, we don't have a crystal ball. At this moment, we wouldn't know. But as you go through more and more IPO, you know that whether this kind of money, after it's spent, does it justify the reason for them going for IPO, right? So just common sense thinking, right? Now, if you are faced with two companies, for example, let's say A Nasi Lemak company is just raising fund to support their cash flow because they have cash flow issue to buy more inventory versus let's say my company, I'm trying to expand more aggressively. Trying to set up a central kitchen. Which one sounds more attractive? Right? This is a very simplified and dumbed down version, but reality is there are fancy names or terms that the company raise fund for, but ultimately you need to determine whether the justification of them raising fund, whether does it make sense or not. Okay, so typically when a private company, as shown over here, they want to raise fund, typically they have three choices. Number one is to raise fund through the 3F. What are 3F? Family, friends, and the fool. This is very typical startup way that you go and ask the mom and pop or your friends to come and invest in your company, right? This is very, very typical. The second way is probably more stressful. Some of you couldn't sleep at night. For those who run a business and you have a bank financing, uh, if you have a house loan, you know how it feels, right? Every month that the bills come on, you have to repay the house repayment. So it's the same feeling, or even worse, when you take up a bank financing for working capital for your company. Okay, so it's a debt financing is what we call. You have more responsibility to service the loan, and your business might get impacted by the repayment cash flow. Okay, so the third way is the best way, in my opinion, is that they go public. They will go public and they raise fund, which is going through the IPO exercise. Okay, so just to recap, the first way is very informal and effectively, I would say, is borrowing money from your close relationships. Usually, though, these have no black and white and it has the least pressure. Usually, this happens in startup. And second way is bank financing. You have a certain financial number that you can show to the bank, but in other way, it will jeopardize may or may not jeopardize your cash flow with the bank financing. And ultimately, the third way, as your company going to public, you have the growth potential, or you really need the money to grow, and that way you can choose to go for IPO to raise fund, and everyone can now invest in your company, right? So it's just a process of allowing a, say, private company in a context, in Malaysia, usually these kind of companies, they are Sendirian Berhad, or sometimes it's even Berhad. So when you see the name, right? When they go publicly traded, they will change into Berhad name, okay? Because it's a public company by then. And this company is able to be accessed by the public. So there's one thing I would like to highlight here is that when they go to public, everyone can access the company, everyone can invest in the company. So it becomes very scary, and it's very important to protect the minority investor, which are people like us, right? So the due diligence process is very, very tough for a company to be able to go public. So I explain a bit more on due diligence part later on. Okay. And why would a company go IPO? Apart from the fundraising reason that I mentioned just now, in fact, there are a lot of business owner, they actually see the opportunity of unlocking value through going listing of their company. Let me give you an example. We use my imaginary company again, Max Nasi Lemak Sdn Bhd. So in a dreamy world, in a blue sky scenario, the company is earning 1 million in profit after tax every year. So assuming no growth for the next 10 years, if I want 10 million out of it, what are the choices? I could stay there, I could work for the company for the next 10 years, so I can get 10 million out of the company. Or alternatively, I could choose to monetize the company, right, by listing it, or to sell the company at a 10 times price to earnings, which is the PE ratio, right? Meaning how many times you're willing to pay for business for their PAT, profit after tax, right? And so that you can fully exit the company. I can immediately exit. In that case, I can immediately capitalize my investment if I'm going public or I'm selling my uh, company directly, right? So I don't have to wait 10 years every year to get wait for the profit, wait for profit, wait for profit. So it's in a sense, it's unlocking value for the company. Before listing, probably your company can generate a couple of millions to you, but after listing, you suddenly see a lot of owners they become multi millionaire. This is through unlocking the value of that company. Okay. But for those who are in business, right, you are extremely lucky if you can get a 10 times PE to get someone to buy off your company. But when you go IPO, things are much more different. Okay. So when I mentioned just now, right, let's say Max Nasi Lemak Sdn Bhd. I'm trying to do lobster nasi lemak. I'm trying to, sell drinks. I want cross-selling revenue and also want to build a central kitchen. So I need to raise fund to go for an IPO. When I mention raise fund, there is a price to pay. It's not that I come to the market and I raise fund is for free. No, there's always a price. In this case, the company, they will need to sell, or they would use the word dilute their shares to give the shares to investor in exchange for the money that has been injected to the company, right? From an owner perspective, so you imagine initially you enjoying a whole piece of pizza, right? You are able to enjoy it fully, which is the PAT, the profit from the company. But now, when you want more of it, you can choose to eat everything by yourself, or someone offer to take, let's say, quarter of it, which is 25% of it, but they give you a 10 times larger pizza because more people are participating. This is what happened when a company goes IPO. Logically speaking, for the owner, right, they keep 75% of the share, which is the maximum percentage of shares that they can keep before they hit a certain listing requirement. There are exemptions like Mr. DIY, but that one is a bit too complicated. That's on public spread. We're not going to touch that. But basically, when a company go for IPO, normally they will be able to keep a maximum of 75% of their shares. The remaining 25% will become the market float. Okay, in that sense. So ultimately, the pizza or the pie has been growing on a larger basis. Everyone can enjoy a larger basis. And going back to the company, right? When the funds are injected to the company, they are able to do whatever they want. For example, like set up a new factory, new market expansion. So the potential valuation of the company, ultimately, they could go higher, which is the market capitalization. When you see, oh, this company hit 1B market cap, 500 million market cap, and whatsoever, this is the so-called market valuation that people has been talking about, right? It might not directly reflect, they might not able to directly monetize it. You cannot say, I have 1B worth of shares, I want to sell it immediately. It's not that liquid if you have that much share, right? But your net worth for the owner side, you will see significant increase. Okay. I hope I don't complicate it too much, but fundamentally speaking, when a company, they go public and their shares are being traded publicly, there will be a floating price. So imagine if you open up whatever trading app you have, the numbers that are jumping around, or the code that are jumping, plus one tick, minus one tick, plus 20%, plus 10%, or go down by 20%. So these are the public opinion pricing on that company. Behind each of the code, there's actually a company that is running the business, which is after they gone for the IPO. Okay. And okay, before I go to the branding point, I also want to highlight that a private company compared to the public company, a public company, they have a significant capability to raise more fund. Apart from when I go IPO, of course I can raise fund. But post IPO, after I got listed, I have a lot of vehicle that I can use to raise fund. You'll always see companies doing all these kind of corporate exercises. Number one, private placement. Number two, right issue. Number three, warrant issuance. Then number four, preference share. Number five, they could go for sukuk or bond, or even higher bank financing. So these are the privileges of a company being public. Okay, if an owner, they really want to expand their business, so going public to raise fund, it's definitely a very perfect avenue for them. Okay, but due to the complexity of the exercises I mentioned just now, probably I'm not gonna go too deep on that. Okay, and the next pointer is also very important for the business owners. Why are they going for IPO? So when a company got listed you will see a lot of media exposure and the public talk about the company. And now, of course, you also see in social media as well, right? And the impact to that is that this would directly improve the company's branding, their market proposition as compared to the private company. When they are a private company, probably no one talks about them. But when they're going listed, so everyone will talk about, oh, what's the share price of them during the first day? They have announced their quarterly report. They just got listed. How many percent? How many times over subscription? So all these are free publicity for that company, right? So for example, if let's say again the same example, right? Max Nasi Lemak Sdn Bhd is not listed. Nobody knows about them except the customer. And then ABC Nasi Lemak is a listed company on Bursa Malaysia. So both of us, we walk in to a bank and then we try to tender for a catering job. We want to offtake their whole building catering job for Nasi Lemak. Under similar price and product circumstances, who do you think the bank would choose? Naturally, they would choose the listed company. Why? Because there are a lot of visibility that they can check on the public company, saves them a lot of time for due diligence, and it's likely that they are able to fulfill huge orders due to their financial muscles being a listed company, right? So you just translate this into companies that are bidding for projects, be it construction companies, M&E companies. So it's a very strong branding and market proposition impact for them. Okay. And also one of the reason is when a company grow to a certain scale, there are always people that they want to participate in the company. Another case, for example, if today I were telling you Zeus is going to get listed, how many of you would be interested? Okay, personally, I would spend probably I would buy at Zeus Coffee at least one per week. Okay, not trying to advertise for them, but personally, if they got listed, I would believe a lot of people could be interested. So this is where their customer, their stakeholders, maybe their suppliers, their employees, they can also participate in the company. Vice versa, when they are a private company, it's very hard for all these stakeholders to participate in the company. Supplier, employees, customer, right? But after listed, you see a lot of different exercise. They can do employee share option scheme, which is ESOS in short, to reward their shareholders. Okay, and also to they could give some share, not give, they could sell some shares to their vendor or their clients. Just ask them to participate in the company through the public shares, right? And just for information, if you came across private fundraising exercise, unless it's licensed or you are a sophisticated investor, private fundraising is generally not allowed in Malaysia unless it's licensed. So be very careful with that. Okay. And last but not least, is also a case for debate later on, which is this is a case that is a bit rare, where the owner or a shareholder, they would like to exit from the company. Now in Malaysia, I think the more well-known case of a successful exit, it would be cases like Citos, Mr. DIY, EcoShop, where the investment vehicle for the investor Brahma has successfully exited after they groomed the company to a certain scale. Again, going back to the point number one, they have unlocked the value of the company. They have assisted the company to get better branding and market proposition, right? This is where they get out with a profit, of course. Okay, but if you see that a company is aggressively, the owners, the founding team, is aggressively selling their shares afterwards, unless it's selling to a strategic investor or they're selling to an institutional investor, generally it's not too good of a sign. It's a very simple equation. If you believe your company so much, why is there a rationale to sell your shares, right? Unless otherwise you have the pressure to increase the liquidity of your company. It's very straightforward. Okay, but going public, surely they have a tons of benefit, but it's also equally hard to go public for a company. So over the thousand, I think close to 1,100 companies that are listed on Bursa Malaysia, they gone through a very hard process to go listed. And after going listed, they have a lot of additional compliance costs, reporting costs, ESG costs, all these are the costs that the company need to bear by the company, right? But unfortunately, I believe, or from what I see, there are still a lot of Bursa Malaysia listed companies. They are still taking the Sendirian Berhad mindset even after listed. So this would, why is this important? Is that they would impact our participation or the transparency of the company when we are trying to access the prospects of the company. Okay, but that one is a bit beyond IPO things. Okay, and just for information, after you understand why the company is going for listing, it's very important because when you are accessing an IPO, trying to understand the rationale of why the owner wanted to go public, to me, is very important because you want to know what exactly is the reason that you want to exit or you want to sell partial of your shares to public, which are us specifically, which are investors, right? So understanding the rationale or the reason behind is very, very critical. Okay. Now, for if any audience here you're interested of getting a company to public, here's a very simplified version of how the listing process will look like. Okay, first you'll need to have a running business. If you're earning personally, if you're a personal individual, you're earning a lot of money, you might ask, can I list myself as a public listed company? Unless you're able to chop away 25% of your body and share to investor, I don't think so, right? So it must be a legal entity. Most of the time, it's a Berhad vehicle, right? A holding company. Then this is the starting point, okay? And you need to fulfill a lot of listing requirements. So from basics, things like compliance on premises, you have the operating license. Okay, you might be actually surprised, right? How many businesses or companies in Malaysia, they fail to list due to this kind of licensing issue. For example, the CCC on their premises, they don't have all this certification and they are unable to list because of that, right? Then afterwards, it also comes to sustainability of their business. So the companies that we see on Bursa Malaysia now, of course, for companies that have been listed for very long, they have undergone change of ownership and also change of business. So it's a bit different. But when they are just started to go listing, it's very important to assess the sustainability of their business, which means that after they got listed, can you sustain at least the same volume of business after you got listed? If not, you're listing a company that's going downhill, so it's pointless for investor to invest in you. Every one of us, we want to invest in a growth company, right? Very straightforward. So if there are businesses that are cyclical, not sustainable, it will be relatively hard for them to go for listing. Okay. Now, there are three key markets over in Bursa Malaysia. The lead market. Lead market, the regulations are very loose, I would say. You use the term loose. Usually, it's much more easier to get listed, but the amount of funds being raised are relatively lesser. Okay, for example, there's one company that just launched their prospectus today. I believe it's called Express Power. They're raising 36 million from the public. By contrast, if you're going to LEAP, probably you're going to raise 5 million and 2 million or around that figure is going to go to advisor fees and also listing fees and whatnot. So there's a huge difference in the fund being raised. Plus, when a company is going to LEAP, a lot of investors are unable to invest in them unless you are a sophisticated investor or you fulfill certain requirement. There comes the more vibrant ACE market. ACE market on paper, we do not have a profit requirement, but given the strong demand for listing on ACE market, the sponsor or investment bank now, they would be quite selective and they would only choose company with a certain profit amount and above, right, to go for listing. And then, of course, ultimately, you have the main market. To be listed on main market, there are a couple of tests. There are project testing, profit testing, and also market cap testing. It's a bit complex on that end, but basically, if your company is able to hit consistently every year, for example, 8 million, and cumulatively you have 20 million for the past 3 years, every year you have a positive operating cash flow, then you can try to go for main market. Okay. That's one of it. So basically, once you are able to fulfill all these basic requirement, then there goes the due diligence process. Is there any funny kind of activities behind the company? Are there arm's length transaction, which means the transaction are being fair? So if there's unfair transaction in the company, right? So what would it mean for minority shareholder after they got listed? So it's also a red flag. For your information, in the prospectus, usually on section 10, or depending on which sponsor it is, usually they would outline the it's either on section 6, section 7, or section 10, right? They would mention the related party transaction, which is between the company and also the related parties. For example, if I'm doing again, I'm doing nasi lemak business, I'm constantly buying rice from my uncle. How do you know that my uncle is selling the rice to me at a fair price, right? So they need to go through some due diligence whether the rice being sold are fair, and why can't I source for alternative on the market, right? Do I have a very strong competitive edge? Is there a discount? Is the discount sustainable? And so on and so forth, right? So there are a lot of answering questions before a company can go for listing. Okay. After that, then they go for the submission, which you would start to see the prospectus draft or prospectus exposure that you will see on the news. They have not been approved yet, but the prospectus draft is there already. And ultimately, they wait for final approval. And once approved, and they start to raise fund from public, and the company went officially listing. Okay. So basically, that information that I shared just now, I would think that it's a bit complex, but I think it's very important for you to have a glimpse of how the IPO process work. I don't think a lot of people has been talking about that, and also understanding the rationale of an owner behind why they want to go for an IPO. If they have a plan to exit gradually from the business, my next question to look at the IPO is who is going to drive the business, right? If you're investing in a company, then what is your investment horizon? Given that you know the owner will eventually exit. For me, the investment horizon is never. I wouldn't even try that because I wouldn't know who will be driving the company afterwards, right? The owner focus is now on selling the company. It's not on taking funds and grow the company. Okay. So later on, we will talk about what are things that we need to go through in the most important document for you to read to understand an IPO, which is the prospectus. I think that's a typo over here. Supposed to be prospectus. My apologies, but this is the one key document that you really need to go through. Okay, so what exactly is a prospectus? This is my personal collection. I'm a geek. So I'm also a nerd. So I like to read a physical copy of prospectus. Basically, a prospectus is a book that are few hundred pages thick, and it goes from A to Z explaining the IPO. Of course, it also come with a summary of the IPO. I think personally, I've gone through most of the prospectus for the company that are listing in 2023, 2024, and up to now is 2025. So yeah, that's my personal background. But it doesn't mean that you need to read through all these things. Now is the time of AI, right? Maybe you do not have the luxury of time to go through all these things. You have the luxury of tools like Notebook LM. Just upload the prospectus, the digital copy, and ask the AI to summarize for you. But be careful. It's a very good tool, but it's not what we would call it's not really perfect in a sense. There could be also mistake coming from the AI, right? You can also create your own audiobook through the Notebook LM. Personally think it's quite useful, but you need to fact check a lot of things when you're doing it. If you really don't have the time, an alternative is also you wait for the analyst report to come out. It will be a bit more summary version, and of course it's written by another individual. There are some bias element involved, so you need to read it more carefully. Okay, so basically again, the prospectus basically contains the summary of an IPO, right? What does the company do? what are their financial performance, what industry they are in, how do they run their business, who are the management team, what are the risks behind, and there's a dedicated market research report and also in-depth financial reporting for that company also. And of course, that includes the risks and also the summary of the offering. For example, IPO price, what's the valuation of the company, what's the PE, how many percent of the shareholders shareholding will be diluted, who are the shareholders that are selling their shares. So you will get a glimpse from there. Okay. Then again, back to the very first few pages that we have shared just now, right? You will also see the utilization of funds from the IPO. Where exactly are they putting your money in, right? This is very, very important, okay, to me. And next, you also have financial information and also valuation. Financial information is crucial because you do not want to invest in a company that is going downhill, right? If you invest in a company going downhill, the valuation of the company is likely to go downhill as well. So why would you want your value of your investment to go down eventually? So to able to identify the company is on growing trend, looking at their historical, I know some of you might find not sufficient. Some of you like 5 years, some of you like 10 years. But unfortunately, if you are going for IPO, usually they have 3 years and maximum 4 years of financial data for you to crunch, and that's it, right? And also risk disclosure. You will also understand what are the risks involved exactly in the company. They will give you a very detailed overview on the risks associated with that company, right? So I want to highlight that prospectus is useful, but it's not perfect. It's not a perfect tool. So this is a IPO performance snapshot that I've gotten from Bursa Malaysia, right? It's a publicly available information. And this is snapshot on 15 August. So I believe you all can see recently there are some of the companies that some of the IPO the performance not really going so well. I'm sure they have something to do with the macro economy as well. But I just want to highlight over here, if you can see over here, these are the performance first day. This is the first day closing versus the listing price. Okay. On the initial of the year last time, we have been seeing every company they can go and perform, right? But coming to recently, you start to see not every company they really can perform on the first day, right? So the myth of IPO is surefire way to earn money. Please don't believe it. No such thing. No investment is surefire to make money. If you don't do your homework, you are surefire to lose money, right? So basically, these are the historical performance of some of the IPOs. If you would like to trace the latest performance of the IPO, it's a very detailed number, I would say. The listing price against the first day, what's the closing price, and also what's the recent price. Then you would know how the IPO market has been performing on an overall basis. Okay, now we're going to go a bit deeper into things that we need to study in a prospectus, right? One of the things that I want to share a bit of my personal belief is that we know that money can compound itself, right? But I believe knowledge can also be compounded. The more you understand about an industry, the more easier you can spot whether the owner or the prospectus is exaggerating, whether they are overly bullish or they are overly bearish in that sense, especially if you are in that industry, right? But as you know, we need to expand our, I would say, I forget the term for it, but basically our circle of understanding. The more you read, the more industry you understand, the more you are able to link the correlationship between each and every industry, right? For example, when the oil price on the upstream go up, you will know that the service provider, they are likely to perform well. And then on the downstream wise, it may affect because the cost for manufacturing plastic is higher, it might affect their margin. So might not be a positive factor. So this All these are coming from, understanding different industry. And understanding the business model of a company in the prospectus, I think, is the most important thing. This is where you can understand and try to forecast or try to work out their future financial numbers from understanding their business model. For example, this is taken from the company that I mentioned just now. Recently, they have been performing relatively well. Again, it's not a recommendation, but just want to highlight that recently, out of the recent IPOs, this is one of the company that has been performing. I think it's also favored by funds. Anyway, this company is involved in doing precision engineering, and also mechanical assembly, right? Basically, in layman terms, so they buy a block of metal or they buy a piece of sheet metal with all this CNC machine, molding machine, whatsoever with the machinery. They will make it into small parts that their client wants, right? So this is an very interesting industry. Depending on who you serve, they are serving semiconductor. They are also serving a construction company. I wouldn't call it construction. I would say construction technology company. That if you are living in Penang, I'm sure you've seen the logo of their client before when you're passing through the highway, which is the SIBS, if I'm not ring SIBS, if I'm not mistaken, right? This is one of their key client. Okay, so in the prospectus, you can see in detail specifically how they run their business. So they receive a purchase order, they start to design, and they procure, which is they buy the raw material, and they start production planning, whether it's going through the machine or it's going through injection molding, which usually is for plastic, right? And finish assembly and then send to client. And this is how they generate their revenue. Okay, so you have a basic understand of that company before you invest. It's not that when you talk to your friend, he or she introduce you a company and tell you that this company is a technology company. So it has a great prospect for investor to invest in. So by nature, you feel impressed that, oh, the high growth technology company. But when you ask a further next step, what specific technology that this company is doing, right? I could say that a lot of people, they wouldn't be able to tell you what they do. If you don't even understand what specific technology the company do, right? It's a rabbit hole, you never ending, but have a basic layman understand of what are the products that they do or what they do, right? So you are able to see whether this thing is something special or something that is niche. Okay. For example, um, for construction industry, as long as you have CIDB license, you are able to participate in the tender. Okay, a lot of times, especially for residential. But for businesses like, for example, like Oxford, this company is called Oxford Innovation, right? They are involved in precision engineering. So what are the things that you need? Number one, engineering capabilities. Number two, you have a factory with all the correct machinery, right? And number three, you have the design capability. And number four, you know how to assemble the product. So you need to have the knowledge of what their customer is doing. So this is relatively a harder industry to penetrate as compared to, a construction industry. So understanding this, I think, is very important in that sense, understanding business model. Okay. And financial numbers. Okay, if you are new to uh, studying a prospectus or you're new to investment, don't worry. I believe nowadays with AI, you can ask the AI to elaborate to you each of these financial item, what does it mean? Basically, the revenue is the sales of a company, and this is the profit after tax of a company. So it will showcase to you what are the historical financial performance of the company, right? This is 4-year basis from 2021 to 2024. You can see the numbers are increasing here. But I want to reiterate that Oxford is a special case where they have some merger and acquisition ongoing for their company. Hence, you will see a very significant increase in terms of the number. Okay. And as you go through more and more prospectus, you will start to wonder Why do you enjoy a 28% margin, which is very, very good, right? Profit after tax margin, and it drops to 16%. Why? Is it because the acquisition that they have done? Or is it because raw material prices increase? Or is it because their competitiveness go down? There are a lot of factors that could be affected margin. Now, since we are talking about financial, profit margin is a very important factor for you to determine the competitiveness of an industry. The lower the profit margin, it means that the more people that can do the same thing. Okay, I'll say it again. The lower the profit margin, the more companies can do the same thing. Why? Because if they're in the world, you are the only person that are able to do it, and there's demand to it. How high is your margin? It's determined by you. Okay, assuming you are the only guy that is able to do it. But when you have another guy that are able to compete with you, then you need to start thinking about your pricing strategy. But if you have 100% that do the same thing with you, then now you need to start maybe throwing prices. Okay, so profit margin is a very important indicator. Going up or going down, going up is naturally is a good thing, but you also need to identify whether this is organic. What does organic mean? Organic means that there are no one-off item. For example, they don't sell off property. There's no extraordinary items that are coming in into the company, right? That increases the profit margin of that company. Okay. So when it's going down, again, try to understand what's the reason of the profit margin going down. Okay. And these are the asset, net asset, current asset, liabilities. These are another, whole rabbit hole to go. But you get the idea. Try to understand the financial performance. To me, the higher, of course, the lesser your gearing, the better for me. But I also understand that there are some industry, for example, like a construction or maybe a property development industry, you couldn't ask for a very low gearing. It's almost impossible. Because when they need to spend money, few 100 million to buy a piece of land, you cannot expect them to have cash or do equity financing all the time to maintain low gearing. It just doesn't make sense. There are industries with high gearing. You have to accept it if you're interested to invest in them. There are industry with low gearing, for example, technology company or software company, right? So you need to be able to determine them. Okay. And this is also very important for me. Basis of arriving at the IPO price. So when you see an IPO price, you need to understand how do they come up with this IPO price? What's the rationale behind? How do you define this valuation? Let's say for this company is 13.2 times. How do you define that? It's based on their financial year 2024 performance, the PAT, right? How do you determine 13, 15, 10, 8? These are very random numbers, right? How do you determine whether it's a good valuation? Generally speaking, this is a rule of thumb. There's no hard rule, but for my own assessment, okay, typically when a company is commanding historically, looking back, sorry, let me go back. Looking back historically, when a company is commanding 25 or close to 25 times in PE and above, usually has been priced in already. A lot of things has been priced in. Usually, I'm not saying every time, but as a general rule of thumb, when it close to 20 or 25, a lot of times the valuation has been priced in their future growth factor already, right? Because if a company is so sexy, the company is now selling at 15 times PE. To go to 20 times PE with more people participating is much easier to go from 25 to 30. I hope you understand what I'm trying to explain here, right? Okay. So understanding the basis of that valuation is very important. Then, secondly, how do you determine whether, okay, let's say it's 15. Is 15 good or 15 is it bad? There are couple of ways that you can compare. Number one, you look at the growth of the company historically. Unfortunately to say, for a lot of companies that are going for listing, pre-IPO times, they are showing encouraging growth, but post-IPO, due to a lot of additional compliance expenses, as I've mentioned just now, right? Their earnings sometimes would drop, or because of IPO's expenses, their earnings would drop. So you are not able to accurately calculate their PE to growth ratio. So one of the more accurate way, not to say accurate, sorry, a more reliable way to compare the valuation of an IPO is to compare with their peers. Okay, for example, when I know this company, they are doing precision engineering. Okay, they're serving semiconductor client and also construction technology client. They are doing precision engineering. They are doing assembly. Now I start to look on Bursa Malaysia. What are the companies that are doing the similar business? Okay, I will look into that to understand a bit more. Okay, then I would come back and compare, see whether this valuation has been justified, or is it fair, or there is potential, or has been overpriced. Okay, these are the things that I would usually do. And okay, before I go into the case study, right? I want to highlight some of the risks, especially with the number of scammers that are out in the market now. You need to understand not every IPO will make you money. This is the harsh rule, as I shown you in the one of the slides just now, right? If you came across someone that tells you this IPO opportunity is guaranteed to make you money, it's either the person is a god or you need to run away. It's a scam. It's either one, right? And IPO are illiquid until they are listed. Understand that when you subscribe to an IPO, let's say you put in 5,000 of your hard-earned money, you put into whatever broker or you go through the ATM, your money is locked there until they are listed or until the balloting finishes. So be very careful when you put in the money. If you are in the need or in the rush to use the money, please be very careful when you put in the money for the IPO. They are illiquid until they are listed. Okay. Due diligence team, I would believe that everyone did their very best to check on the company, see is there any monkey business behind all these things. But there is a limitation to it, right? I couldn't point out more clearer. But there are companies that they are good at camouflaging themselves before listing, but post listing, you would see their true colors. Okay, so if you happen to see this kind of companies or you're involved in it, then it's a bit unfortunate because we did our best. Again, back to rule number one, not every IPO will make you money, but if you've done a good enough homework and you learn from it, I believe it's more valuable than earning you money over the long run. Okay, and your analysis will not make you money. This is to myself actually. My own assessment may not make me myself money during assessing an IPO because on the first day of an IPO performance is very subjected to the market environment. Number one, subjected to market environment. If there's another, negative sentiment announcement coming from Trump during the day of an IPO that I buy, then what can you do? There's nothing you can do, right? You just have to sit and wait. And secondly, if the company, like I mentioned just now, they have a Sendirian Berhad mindset, they wouldn't come out for exposure, they wouldn't do more exposure to introduce themselves to the market. So what can you do? Again, there's nothing you can do. Maybe it's not wrong from your analysis, but maybe your time cost to materialize that investment would be higher in that sense. Okay, so I think that's it for the slides. Let's go into a case study. Okay, give me a moment, guys.
In the meantime, if you have any question for Max, you can start to type them at the Q&A box, yeah?
Yep, I started to see some questions coming in. Okay,
All right.
so I hope you guys can see. Okay.
Yes, we are looking at the prospectus.
Okay, thank you very much, Shane. Okay, this is the prospectus of a company, which specifically is the company that I mentioned just now, right? You have the, electronic prospectus. Usually the physical copy, they don't have this first page. And this is the cover page for the prospectus. This is the last page on the left, and this is the first page. Okay, and then going into the prospectus, they have a lot, sometimes, some technical term, again, uh, with the privilege of having AI, all these terms, you can be answered very easily. The way to prompt it is just to copy paste the word and ask the AI to explain to you in layman format, right? As you go more and more company, you will automatically understand what does this mean. Okay, so sometimes they will also they are unable to disclose their client. If you have the time, what I do is that I would this is a bit too little in information, but sometimes I would just copy paste the whole thing and then I throw to Google. Sometimes they copy the description of the company, then you would know who are their clients. That's sometimes, and these are usually more obvious. They customer G, they told you which year they're listed, memory and storage product, how many employees they have, they're listed on Nasdaq. So basically, if you throw this information to any AI, they are able to access the internet. If you are not having the luxury of time, you can actually identify their client. Why is that important? Is because these are their client, especially if a substantial client. It's very important for you to track continuously whether their client is performing well. If their client are not performing well, what do you think will happen to the company? Right? It's very straightforward. Okay, so these are the technical term, everything. And this is the table of contents. And these are the board members. Okay, so okay, this usually I will skip this part. This is more formality. Okay, these are the shareholders of that company. And then you have a summary of the company. Again, okay, let me share something very important with you all. Public issue, it means that the company raise fund from the public and put it into the company, right? It means public issue new shares in exchange for fund for the company. For example, like what I mentioned just now. Offer for sale, on the other hand, is a different thing. Offer for sale specifically means that the owner, they are selling their shares. Normally, I mentioned just now, when they go for IPO, they will dilute anywhere between 25 to 35% of their shares. That's the maximum I've ever seen. Minimum I've seen is 15%. It's called 9S Mid-Mat. Okay, I did a sharing last time, but that one is passed already. It's a very rare case, but on an average basis, it's in the band of 25% to 35%. And you need to identify how many percent of shares that the owner are raising fund into the company, right? In this case, 27% of shares are being diluted. Sorry, 27% is being diluted. And 7.04% is considered offer for sale, which means the owner, they sell the shares of the company and it goes into their pocket. If you ask me, anything below 10%, I think is reasonable because they have run the business for so long. From a business owner perspective, to cash out partially, I think is quite acceptable. But anything above 10%, I'll be more skeptical to it. Okay. And this would be, the subsidiary of the company. Basically, this part you can ignore. It's not very important on the subsidiary unless you want to go to a rabbit hole to go and search on Google on each respective company if they have any cases before or anything they have appeared on media before. Although it will be in the deeper parts of prospectus. But if you want to go that extra mile, be my guest. This is the elaboration of what does the company do, right? They're doing precision engineering, sheet metal component, which is a piece of flat steel. So they do sheet metal fabrication, whether it's punching hole, laser cutting, welding, blanking, and all these things. Then they will do CNC machining as well. So basically, they are converting a piece of metal or plastic pellets into a product or a parts for their clients, right? So this is a bit elaboration, and they would usually tell you the principal market. Are they in Malaysia only? Are they in the foreign market? If it's in the foreign market, then you need to start thinking another question, which is related to the forex gain, forex losses. Okay. And usually most of the prospectus, the sequence are same, but there are exception. On section 3, they will tell you competitive strength. Some of them would be telling you about the risk. Risk is combined with section 3 also, risk factor. They will tell you that, oh, they are dependent on certain major client, right? Largely dependent on end market, which are the modular business system, okay, which is the construction technology company I mentioned just now, semiconductor, E&E, electrical and electronics, a telecommunication market, ergonomic furniture, which is the gaming chair and whatnot, automotive industry, and etc. Right? These are the markets that they serve. This is also important for you to determine. Very simple. If the whole semiconductor market, I was telling you that whole semiconductor market is slow, what do you think will happen to the companies that are involved in the value chain, right? You sometimes that you really can't fight the macro factors, okay? And then they will tell you again, why do I want to reiterate the working capital and uh, capital investment, which is the capex, is because working capital is something that you need as you run the business. For example, if I'm running again a nasi lemak business, I need to buy sambal, a raw material for sambal. I need to buy rice. I need to buy egg. I need to buy prawn. Um, and I need to buy spices. All these are working capital. But capital expenditure is when I want a central kitchen. I'm investing in the factory, which is one-off in nature. After the factory is being built, the machineries are in. After I buy them off, it's a one-off basis. So you need to understand whether this company they're serving working capital, which is continuous, or is on capex basis. Capex is more cyclical in nature, right? So you need to understand the cycle as well. Okay. And yeah, these are very generic terms like exposed to disruption. Okay. And this will be the future plans, what they are planning to do, right? Expanding their production capabilities. So the next part, section 4, usually it would go a bit deeper into utilization of their process. This one is on 3.7, right? Sometimes they're in section 4, depending on the sponsor. So they will tell you what they are doing with their funds. Usually section 4 is the expansion of it. Okay. So they also have a dividend policy. To be fair, I would say on average 70 to 80% of the companies that are listed on ACE, they will not give you the dividend policy. Maybe they don't want to tie themselves up or they're expanding quite quickly. So they would not have a formal dividend policy. But they would still pay dividend to themselves on and off. Okay. And this the details to their IPO, right? Offer for sale. And most importantly, I would go quicker for the interest of time. This is the part that we mentioned. How do they come up with the pricing and dilution and also utilization of proceeds, which is on 4.8, right? They will tell you they're building up a new factory, okay, constructing a new factory, Patukawan 1, Patukawan 2. Sorry, actually their new factory is on this one, Penang Science Park, which is extremely close proximity to their client. This is why they want to build up the factory. I'm not sure if they would mention that. Okay, yep. So they are anticipating order coming from the customers, which is the SIBS. They have a forecasted demand. It's in a prospectus. It's public info, right? So they have the supply agreement. So it's very close. If you have the time, just open up Google Map, and try to see where their new factory is. Look around the Google Map. Sometimes you are able to identify who are their clients, right? In close proximity. There's always a reason why they want to set up a factory over there. It's usually because of the ecosystem or their client is over there, right? Okay, so these are the indicative timeline for construction. This is the capex that we keep talking about. And this also capex, they are buying new machinery, right, for their plant. And this is working capital. So you can see over here, they're used for buying raw material, Yeah. Stainless steel, roll sheets, mount, steel plates, and hardware, and also other parts for their clients. And listing expenses, quite standard, is usually around, for Ace market, is around 4 to 5 million. It's quite standard. For main, it's a bit more different. Okay. And these are the more formality parts. Most of the prospectus is more or less the same. Then you have part 2. Okay, give me a couple more minutes, then we will move into the Q&A section. Right. Okay, so 5.1, depending on the sponsor, once again, right? Usually section 5, they would have an elaboration of the background of the board of director, and also promoters. Promoters meaning that the major shareholders or the person that are selling their shares. Okay, so over here you can see the background of the company, background of the owners, where are they from? Sometimes you can see very interesting board of directors over in the section 5. If you have the time to go through the whole thing, right? You can see that where are they from. For example, some are from, I've seen oil and gas company. A lot of their board of director, they are ex-Petronas person. So whether they have a synergistic impact on that is very important, right? Yeah. So these are the backgrounds of the shareholder. And I believe these are on director, right? They're chairman and whatnot. So these are the parts that if you do not have time, I would say you can skip, right? More importantly, you need to understand the background of owner. Where are they coming from? Like, for example, is involved in MIMOS perhaps before. This is their chairman. So there are somewhat exposure in, in the MIMOS side. Okay. Okay. And usually I will go a bit faster. And section 6 is usually the background of the company. Okay, these are key management. Okay, section 6 or section 7 is usually the background or historical information of the company. It would tell you in chronological terms what happened to the company before. Right, I think it's a bit further. Because they have a lot of acquisition, so this one is a bit more complex. They will also elaborate how does the acquisition work, right? This one is a bit more complex. But usually on the 6.1, they will immediately tell you how the business started. In this one, they have to segregate into different segments because of the acquisition, right? So yeah, on section 6, they will also disclose their major customers. This is compulsory on every prospectus, but more and more, I seen a trend more and more, they are trying to, protect their customer. They would choose not to disclose. So if you really want to find out, there are two ways. Number one, go through the analyst report. Sometimes they will slip out. Or number two, you can just find out yourself if you do more, homework on that. Okay, so these are customers. Then you go to supplier, major supplier over here. So you know who are their major suppliers are. Okay. And why is it important on a supplier? It depends on how reliant they are. For example, this is a company that they have already acquired, so it's not so important. But in some cases, a lot of raw materials sometimes are bought within one single company. So sometimes there's a risk associated. Okay. Go a bit quicker. On the part 7, I believe they are going into the business model of the company. Okay. So they have here section 7, historical of the company, right? And they will go deeper into what they do, explain in depth. If you really do not understand, I think over here they explain it quite well. Okay, although honestly, it's a bit boring to read sometimes. But as you go through more and more prospectus, you are able to read it more faster and faster. Okay, so yep, this the SRS automated storage system. They also do automated guided vehicle, AGV, all these things they would show you as well, right? Okay, and number 7 is competitive strength, but they go deeper. Number 8, I think, is risk profile. It's either risk or IMR report, right? Okay. So you guys get what I mean? Sorry, it's a bit long. Yeah, it's really long. For OXB, it's a bit long. Okay, so number 8 for them is IMR report. IMA report is also very important because sometimes you do not know where to look for their competitor, right? Just look into IMA report, scroll to the last few pages. They will provide a competitor comparison. In the event you have zero knowledge about the company, remember when I mentioned PE just now, how do I compare peer PE? So I will look over here. Are there any companies that are listed on Bursa Malaysia? I will do a comparison. It doesn't mean that it's, directly the same. Maybe the competitor is trading at 10 times. There's a hard rule that you must also trade at 10 times. Maybe my margin higher or lower, so it's also subjective, but at least you get a bit of a guidance. For example, MFlex, I think a bit more different, maybe on the assembly part, right? But Coraza, yes. SFP Tech, SFP Tech is here, and also UWC Berhad, right? All this precision engineering company. SAM Engineering is not here, probably because of size or whatever reason, right? Or YBS is also not here. Okay. So number 9 is the risk profile, reliance on their customer. And then number 10 is RPT, the related party transaction. And number 11 and 12 are usually the financial report for the company. So that one is when you want to dive deeper into, number 10, RPT, right? And number 11 and 12 are usually the financial performance. Okay. Over here. Yep, historical financial performance. So it's a bit deeper that they will explain in deeper terms, right? On year-on-year comparison, they will actually break down what are they revenue by industries. This is also quite important. And they will also provide a comparison. This is very important for you to understand why this year margin is higher, why this year margin is lower. Okay, so that's how do you go through the whole prospectus, and things are more important. I would say section 3, section 4, section 7, section 8, which are basically the offering, the brief of the overview, history of the company, a partial understanding on the management of the company, and IMR report, risk exposure, and also if you want to dive deeper, you can always go to section 11 or 12, look into the financial report of that company, right? So I think that's on my part. I'll pass it to Shane for Q&A session.
Thanks, Max, for sharing with us about IPO and what are things you should look for to get a good IPO, right? So these are the essentials that we need to know about initial public offering. So if you have any questions you want to ask our speaker today, please write them at the Q&A box, yeah? Not the chat box. All right, Max, the first question I want to pose to you is, how do we look for red flags in the prospectus?
There is this is a bit tricky. Okay, there's one instant that I'm looking through section 5 just now. I identify a very funny director profile that is not usually have been seen. I don't know if I shared with Shane before previously, right? It's I don't think I should disclose the name, but after that it's a red flag. It's not supposed to be disclosed on prospectus, I believe, right? But that's the background of the director that make me back out from that investment. And other red flags, I would
Is that
believe
a executive director or independent director?
independent.
Independent.
Independent director. Yeah. So I
So you
backed
feel
out.
a bit fishy that they appoint maybe an irrelevant independent
No,
director on
it's
board.
not irrelevant. He's also shareholder of the company. Sorry, it's a director. It's not independent, sorry. It's
That
non-executive, non-independent, non-executive.
non-independent, non-executive.
Yeah,
Oh,
yeah,
okay, okay.
yeah. They have shares in the company. They are promoter, but it's a bit fishy with their background. So eventually, the share price went down. But I don't think I should publicly talk about the name. But red flags in a company. If you found out that, for me, prospectus most of the time, again, as my slide has mentioned, due diligence they did their best to find out everything, right? If you're not comfortable with the business, or after reading it, you still do not understand what does the company do, probably it's a red flag for you personally, because it's very hard for you to track the ongoing performance or to forecast the performance of the company going forward if you do not understand the business itself. So probably, you always say it's better that you miss than you made a mistake in investment, right? Rule number one, never lose your money. That's the key part for me. Otherwise, red flag, if you see financial numbers that are not very realistic, so probably be a bit careful lah.
All right. So, what we learned from you today is that reading the director's profile is also very important. Okay.
Yep.
I guess this is the part that many retail investors will skip lah. All right.
Sometimes I will go
Yeah.
through very quickly also, unless otherwise I spot something very funny.
Okay. All right. Next question here is would you advise people to sell the IPO during the first hour when it debuted on the stock exchange?
Okay, this is another myth, and I believe this one probably you heard this back in 2022, 2023. Why people used to advise to sell on the IPO on the first hour, because back at the days the IPO is not as vibrant. IPO market is not as vibrant in terms of number. Last year I think Bursa did 55 IPO. This year is on the road to 60 plus IPO. Last time is not as vibrant, so the number of IPO coming up is maybe around 30, 40. It's very exciting for a company to come up, and on the first hour, the FOMO, a lot of people that want to get participation. If they miss out on the balloting, they want to get involved. So it creates artificial demand that people want to leverage on the opportunity. So they also buy high, sell higher. These are the mentality behind it. So this is why last time in 2022, 2023, when they get an IPO, is usually they will sell on the first hour or the first trading day, because that's the highest interest. Then following the next few days, that I believe is T plus two, right? Eventually, for those that are using contra account, they need to sell it off because they are trading, okay? Because they are doing trading. So on the T plus two, for example, if you buy on Monday, Tuesday, Wednesday latest is the day that they need to sell it off if they are doing trading. So usually on the next 2, 3 days, it will come back down. If you are able to get ballot, you sell on the first day, then you buy back again on the second and third day. It used to be a strategy back in a couple of years, 3, 4 years. But now I don't think it works so well, depending on the company, because not that much interest on IPO, especially in the second quarter of this year, the lackluster performance of IPO. I believe that impacted a lot of sentiment to chase on the first hour. Yeah, things has changed.
Yeah. So for those companies that are seeking listing in the second half of this year, it might not be as easier as compared to like 2024 kind of craze already lah. Huh?
Definitely.
All right. So the next question by CS is that if I want to subscribe to an IPO shares, how do I pay? Do I pay through my savings account or current account or through my investment account?
Okay, I think great question. If traditionally, I think it's through your saving account. You let's say if I last time I'm not sure for other bank. I used Maybank before last time, so I just log into Maybank and then I key in my CDS account number, my IC number. This is very important. For your information, you can only subscribe for an IPO for once. So it's not like I got 10 bank account, I go and subscribe 10 times, I got 10 chances. No, you only get one chances, one IC number, only one chances, right? So last time is that Maybank can do direct transfer as I'm applying for IPO. Now, based on my information, you can use your trading limit in investment account for Momu Securities and also Malacca Securities to subscribe for IPO on a leverage basis. I believe CGS, they may or may not have this function, but these two are the platforms that you can go through investment account. Otherwise, traditionally, going through saving or maybe current account, there will be conventional bank or going through the ATM. Yeah, if you want to go through investment account, it's the two platform that I mentioned just now. But I'm not associated with them. Yeah.
Yeah, I think these two platforms also not only investment account can also allow share margin financing to buy IPO shares, right?
Yeah, that's also a risk. Yeah, good point. Good point, Shane. There's also a risk because you are leverage. If the IPO is not performing well, number one, you lose out on capital, you incur capital losses, and secondly, you have additional costs on the margin financing.
So let's say if I apply, you know, 1,000 shares in Maybank through Maybank to you, 5,000 shares through CMB clicks, right? 10,000 shares through Public Bank, right? Let's say lah. So I have made 3 applications, which is totally. Would it make my IPO application uh ineligible
I
or
think yeah, they will disqualify you.
okay? So don't make this mistake, yeah.
Yeah, once everyone. Once.
Yeah, sometimes you feel, oh, I feel I undersubscribed already. I want to top up your application amount, right? Then the
Yeah.
second time you apply, you will disqualify you already. Okay.
Yeah.
So the next question here is there a way that investors, purchase the share lower than the IPO price? So this question comes from One Shasriel.
Yeah, post-listed, as you've seen from my slide just now, the snapshot from 15 August 2025, there are IPOs that they drop below the IPO prices. For example, their IPO price is 32 cent, then their share price ultimately they're trading at 25. So if you are really interested in a company, then perhaps this is your opportunity. But if you're asking the possibility to buy below IPO price, definitely possible. Yeah.
All right. So the next question is by Mahalingam. Um, if we read the news that this IPO is oversubscribed, right? How should we react? Right? Should we buy in the first hour or so, or should we get in? Okay, or should we believe in those news and make investment decisions? Or not?
Okay. If you look at the announcement made by issuer house for IPO, okay, you can see that usually there's a tiering basis. How many subscriber that have went on to subscribe different tiering tier? For example, 1,000, sorry, I think it's 100 share to 1,000, and then 1,001 share to 2,000, and then 2,000 to 5,000. So if you are subscribing as a normal investor, right? Normally you will fall under this category. And then they have a category that is be above 5 million, if I'm not mistaken. They have a category, final category. If the oversubscription comes from this category itself, which is the high value couple of million, it would mean that there's one single investor or couple of high net worth investor that they subscribe for the share, which they exceeded the highest threshold, right? That makes the IPO oversubscribed. But if you see a lot organic, the success rate is very low. Last time, from what we see, it's around 3 to 4% success rate at a peak, right? Maybe even 1 to 2 on certain tiers. And now you can see typically it's around 20-30% or maybe 50%, right? If you back to your question, if you see oversubscribed, let's say for 10 times, but the median or the focus of the oversubscription is on the higher end, which means there are people with a lot of money. I'm not trying to say they balloon the oversubscription, subscription, but they are caused by this few person, but it's not the whole market as a whole that oversubscribe this IPO. I hope that explains it.
All right. Thanks, Max, for doing this segment for us. So that's all the time we have for Q&A with Max on this IPO essential. So ladies and gentlemen, you just listen to the founder of Want to Invest, who is Mr. Max Tan. Thank you so much, Max.
Thank you so much, Shane, and thank you everyone for listening. Hope this has been insightful for you all. Thank you.